Welcome to this module. In this module, I'm going to clearly define the difference between a business trust, a private family trust, and a 508 C1A tax exempt trust. Let's get started. Let's start with an unincorporated business trust. So as you can see here, an unincorporated business trust does not need to be registered with your Secretary of State. Because your business is registered with the Secretary of State, it's considered public and anybody can actually look at your business and see who the owner of your business is. So with an unincorporated business trust, you can actually privately operate your business without anyone knowing who the business owner is. And that is just to protect yourself from judgments, liens, and lawsuits. So it does not need to be registered, which is good because that means that your identity is not in the public and your business is not in the public. And this type of business trust is not going to work for every single business. So if you are dealing in commerce and you're dealing with the public, let's just say that you have a hair salon, right? So that's a physical location where people have to go in and get their hair done. Then you need a license. Same thing for a nail salon, a hospital, any type of medical facility, any type of place that has like a bar or a restaurant. This type of trust is not going to be suitable for that type of business, okay? Next, it can actually build credit. So this is a living, breathing entity and it can build credit just like a human can build credit, just like an LLC, an S Corp, or a C Corp can build credit. So in order for you to qualify to be able to build credit, you are going to need an EIN. So with this type of business trust, it's optional for you to get an EIN. But if you want to be able to have a business bank account as well as create business credit, then you're going to have to establish an EIN for banking purposes and in order to be able to build that business credit. Operate in common law. So what that means is this is a non-statutory trust. So it doesn't fall in the jurisdictions of your state or your country. So it's non-statutory, meaning that as far as your judicial system goes, it can't really abide by the legal legislation of your country or your state, okay? So you are operating in common law, so you are operating privately. You are actually dealing in contract law. A lot of what we do in this United States or in this state is contract. For example, you see the lights are on in this studio. So that means that there is a contract with the utility company. You see that this video is available online. So that means that there's a contract with the service provider for this software. So everything that we do is contracts. Whatever you purchase, if you're purchasing a house or a car, it's contract. So the same thing applies for a business trust. It is also dealing with contracts. So this falls under contract law or trust law. And contract law is actually the highest form of law here in this country, and it has to be upheld. It has to be upheld by lawyers, by judges, and any type of judicial system as well. So next, this unincorporated business trust has to be taxed, okay? And it is taxed at 37%, which is a very high tax bracket to be in. You want to be able to reduce that 37% as much as possible. The thing that I like about a unincorporated business trust is that it can do something very uniquely that other entities, if you're operating in business, cannot do. And what it can do is it can do a 100% distribution to whoever owns the business trust, which means that your business trust is owned by your private family trust. So, which means that your business trust can distribute 100% of the income that comes in. So let's just give a brief example. Let's just say that your business trust for this year made $100,000. In a normal scenario, you would have to pay $37,000 in taxes. But because you are very strategic with your taxes, what you are going to do is you are going to do a distribution and you are going to move that entire $100,000 in income to your private family trust. So you're going to move it to another entity. And now at this point, it brings your tax liability of your unincorporated business trust down to zero. That is a huge benefit because now that 37% just got reduced to zero. So another thing when it comes to your business trust is you do not want to hold any assets in this trust. Why? Because you are conducting business, and anything in business can become liable. Let's just say that you have a business vehicle and you get into a car accident. That means that let's just say someone else is injured. That person can sue you. They can sue your business trust, and whatever assets that you have in that trust can now be liable. So you don't want to put yourself in that position. So with this type of business trust, you don't want to hold assets. One, because there is liability attached to that business, and two, because it is operating in commerce and it has a credit score and other things involved with it. Maybe you decided to register it with the public records and the Secretary of State. So you do not want to hold assets on this particular trust. Lastly, like I mentioned, the beneficiary of your business trust is going to be your private family trust. That is vitally important in this type of structure, okay? So now let's move on to your private family trust. So now we are going to move on to the private family trust. So with your private family trust, I like to use the word private because it's a family trust, but with this type of entity or trust, you are definitely not going to have it registered with your county, with your state, or any official place of public records, okay? So this trust is a non-statutory trust, which means that it operates in common law, contract law, or trust law, okay? So it does not fall within the jurisdiction of your state or any type of government that you have locally or in your country, okay? So with this type of trust, if someone was to be able to try to sue you, it would have to go all the way to the Supreme Court, where they are the only judges that are able to uphold that contract law, okay? So it's non-statutory, which is what you want. You want a non-statutory trust versus a statutory trust, okay? It's a private agreement. So a trust is a contract, And it's typically a contract between 3 to 4 parties. And those parties involved are the grantor, the trustee, and the beneficiary. So this is a private agreement or contract, as you have seen with the templates involved in this course, that these contracts can be lengthy as 20 to 30 pages, depending on how you have set up your trust, okay? So with this type of trust, since it's private, we don't want to pull it into the public sector, which means that we don't want to start building credit for this type of entity. We don't want it to have a credit card. The only thing that we would allow for this type of entity is for it to have a bank account. So there are some trusts where you don't even have to get an EIN, and typically for this type of trust you wouldn't need one unless you wanted a bank account. So you would go to the irs.gov website, apply for an EIN, and it would be for banking purposes only. So you are going to avoid building credit for this trust, okay? You want one trust that is specifically what we call a holding trust, which is going to hold all your assets. So this particular trust, it is a pure trust, and so it is actually also an irrevocable trust that is taxed at 37%, just like the unincorporated business trust that is also taxed at 37%. So we are going to do our best to get this percentage down to 0. So your business trust made $100,000 last year or this year, and they distributed 100% of that $100,000 to the private family trust. So one thing that the private family trust can do is, obviously it can give 100 distribution, but it can also receive the 100 distribution. And so what we're going to do is we're going to expend the income before the taxes are rendered, right? So we owe 37% out of that $100,000. That's $37,000, okay? So what we're going to do is we are going to expend that $37,000 down to 0. So that means that you are going to deduct your groceries, you're going to deduct your clothing, you're going to deduct your utilities, your mortgage, your car note, your insurance, your gas, any type of tuitions. And since this business trust owns your assets, everything associated with those assets. So for example, you have maintenance when it comes to your home. That's going to be deducted. You also have, when it comes to your business trust owning the insurance policy, you have that premium. So you're going to have to deduct the premiums. And there's a number of different deductions that you can do in order to, and it's not really deductions per se, because we are not treating this like a business. So it's really expenditures, okay? So that means that you have all of these expenses that have to be met before you can figure out what's left in order to be able to be taxed. So let's just say that $100,000 went into this private family trust and you expended all $100,000. At that point, your tax liability went from 37% down to 0. So now you have a 0% tax liability for this year. What you could also do is, let's just say that you didn't have enough expenses to bring it down to 0. Let's just say that you brought it down to, from 100,000, you were able to expend 90,000 and you had $10,000 left, right? So it would be 37% of that $10,000, right? Well, with that being said, you could actually, instead of paying that 37%, like I said, you can do a distribution. So now what you would do is you would distribute that tax liability, or that $10,000, you would distribute it to your 508 C1A faith-based organization trust, which we'll go over in just a moment. This is the trust that you want to hold all of your assets. And when I mean assets, I mean any vehicles or cars that you have, any type of pieces of real estate. It could be land, it could be houses, hotels, any type of insurance policies. You want the trust to be the owner and the beneficiary of the policy. Also, any type of brokerage accounts, any type of bank accounts, any type of retirement accounts, any type of cryptocurrency that you may own, any type of assets that you have, you want to hold it in your private family trust. And lastly, the beneficiaries of your private family trust are going to be your children. So if you have 4 children, then you have 4 beneficiaries, and you have to split up your trust certificate units, which are the TCUs, into 4. So each trust is going to issue 100 certificate units, which are equivalent to 100% of equity inside of this private family trust. And if you have 4 children, let's just say that you divide it equally, and so you give 25 certificate units to each child, which is equivalent to 25% ownership of the trust assets associated with this trust. Okay, so that is very beneficial. So now let's move on to your 508 C1A FBO. FBO stands for faith-based organization, and this is a trust entity. It is recognized with the Internal Revenue Service, or code. You can find it under code 26 of section 508. Okay, so for this type of trust, there are several names associated with this type of trust. You have church, you have a ministry, you have conventions, you have auxiliary organizations or associations. So this type of trust is faith-based. So another name associated with it is faith-based organization. It deals with any type of charitable contributions that you want to make to the public at large. It can also be religious. That's why they use the word church when it's coming to the 508 C1A. And it could also be educational. So for example, you are in a learning environment right now dealing with this course. So it's educational. So this course is under a 508 C1A trust company, and it's for educational purposes. So you determine what the purpose or mission of your FBO is, and it could be anything. It could be just to serve mankind. So when it comes to an FBO, I just want you to realize that it doesn't have to be religious based, and it is primarily faith-based. So your faith could be in anything. Your faith could be in the universe. It could be in God, Jesus. It could be in water. It could be in humanity. It could be in, the galaxies. It could be in whatever you want it to be in, right? It could be in human nature. It could be in anything. So you just determine what your faith is and what your purpose is, and you can operate this type of trust. So with this type of trust, the number one thing that I want you to benefit from when setting up your 508 is that it's tax exempt. So what does that mean? That means that you do not have to pay any taxes on any donations that come in for this particular trust. Okay, so the way that you're going to structure this business is, one, it's a nonprofit organization. Okay, so that's first and foremost. Two, since it's tax exempt, you do not have to file any taxes. You do not have to report any income whatsoever. So if you look up the tax code, you will see that your gross income needs to be under $5,000 in order to qualify to operate this type of trust. So any income that you have coming in under this type of trust needs to be marked, or it needs to be described, or it needs to be received as a donation. So let's just say, for example, that you are running a real estate business and you have 10 properties, and all 10 properties are filled with tenants, and the tenants pay you on the first of every single month. Those tenants are considered members of your faith-based organization. And every single month on the first of the month, that is the members' donation or contribution to the faith-based organization. So in exchange for your FBO or your faith-based organization, in exchange for you allowing them to live in this residence, they are providing a monthly donation of $2,000 per month, which means that you are going to be giving them a donation receipt, which is tax deductible for them, and you're going to be receiving $2,000, which you do not have to file taxes on. You do not have to report to any type of government entity, your state, your county, or the United States, or the IRS. Okay, so that's the type of position that you want to be in, because at this point in time, those donations that come in, like I said, are tax exempt, and you can then go ahead and reinvest that money into whatever you want. So if that's acquiring another property, that's fine. If that is expending for the trust, meaning that, you need to, go buy clothing so that you look good and presentable when you're out here doing trust business, or you need to go purchase a car for the trust and that $2,000 is being used for down payment, it's up to you. Okay, so no reporting, no filing. And when it comes to you being tax exempt, you are tax exempt from all taxes. Some taxes you do not have to apply for tax exempt status. Some taxes you do. So let's briefly talk about it. For the IRS, you do not have to apply for tax exempt status. It's automatic. So that is something phenomenal, because other entities that are considered nonprofit organizations, they have to apply for a 501c3 status. And you do not have to apply for that, because sometimes with that application, they can actually get denied for a 501c3 status, and then they will not be tax exempt. Okay, so that is an advantage that you are putting yourself in. And when you are avoiding becoming a 501c3, you are also avoiding the restrictions that comes with that entity. For example, a 501c3, they're limited with their freedom of speech, and so they cannot talk about politics or politicians or anything dealing with politics. And so you don't want to have those type of restrictions. It's definitely a good benefit for you to be operating as a 508c1a. No reporting. This type of entity is a nonprofit organization entity, and you can build business credit with this type of entity. With this type of entity, because you are actually, out here operating in the public, it is advised that you sign up with your Secretary of State, you get it registered, and you use a registered agent so that your name is nowhere appearing on the Secretary of State's website, and you can start building business credit as long as you have an EIN and as long as you are registered with the Secretary of State so that they're able to look up your business. And all you have to do when you're registering your business with the Secretary of State is put in your mission statement that you are operating as a 508c1a faith-based organization. So let's go back up to tax exempt, because what I wanted to also mention was, besides the IRS tax exemption, you are also exempt from state taxes as well. And some of these states you might have to apply and some you don't. You are also exempt from sales taxes. So whatever sales taxes are in your county, you do have to go to the Secretary of State's website and apply for that sales tax exemption, and that is also going to bring you through an approval process. Some will not recognize your trust as a 508c1a, and so even though your trust is a 508c1a, they're not going to recognize it as having 501c3 status, and they will deny it. Some states will honor it, and in those states you will be sales tax exempt. Another tax that you will be able to qualify for is your property taxes for your county. So whatever your yearly taxes on your property is, you can actually get those exempt. You do have to apply for it on your local county, and they will approve it as long as the property is owned by the 508c1a trust. So let's move down to registration. Like I said, it's optional. So you can decide to actually register with the Secretary of State, because it's going to be easier for you to get that nonprofit tax exemption for your state and for the sales. And it's going to be easier for you to be able to build business credit as long as your business trust is registered with the state. No W-2 employees. So with this type of entity, because it is a tax exempt entity, it is considered that you pretty much are a nonprofit, you don't make any money. And so this type of business doesn't qualify for you to have W-2 employees. So if you have individuals that you are, that they are rendering services to you, then you have to 1099 those individuals, and they are considered independent contractors. 1099 to receive distribution. So with this type of entity, it is considered a nonprofit. And so you are going to be building an enormous amount of wealth with this type of trust, but you cannot benefit from it. For example, you cannot commingle funds. If you have $1 million in the trust fund bank account for this trust, but you want to go ahead and get a haircut or your nails done or anything like that, then you would have to do a distribution from the trust to your personal name or from the trust to your private family trust. Okay, you cannot commingle funds and swipe that 508c1a trust debit card in order to get your nails done. Okay, so what you would have to do is, like I said, you have to 1099 either your private family trust or yourself. Now that 1099, let's say that you are, let's say that you are actually having your private family trust provide a service for your 508c1a. Let's say that your private family trust did the books, bookkeeping, or something for your 508. So your 508 made $1 million this year. And what it can do is it can now pay for the service to the private family trust of $100,000, right? So now that money is what you can use to do things outside of the trust. It is going to be a 1099, and like I said, it's going to be taxed at 37%, that $100,000. So it's up to you to be able to expend all of that money so that you do not have to pay $37,000 in taxes, okay? So you are going to 1099 yourself in order to receive funds that you want to do or use outside of operating your trust. So that is the difference between a unincorporated business trust, a private family trust, and a 508 C1A faith-based organization trust. I hope that you understood the information. And as I said before, this is not legal advice or tax advice. So if you need any type of further advice when it comes to this, please seek those professionals and do your due diligence and research the information that you are learning in this course. This is the end of the module.